Today we're going to speak about the lending programs from all the major banks, the qualifying factors needed to get you approved, and the features and benefits of each program and how it can help you achieve your target. Now, a lot of times when I'm speaking to a client and I ask them for the use of funds, let's just for an example, they ask me for $250,000. I said, well, what's the money going to be used for? And he said, well, $100,000 is for equipment, $100,000 is for working capital, and $50,000 is for accounts receivables. Well, equipment and accounts receivables is collateralized. This is a much different criteria than versus getting somebody cash. So I wanted to dive a little bit deeper into the different products and how we can structure a loan request to be able to help achieve the client's outcome. So a lot of times we found a lot of banks have these application-only, streamlined, lines of credits and term loans in order to help get to that target a lot faster. Requests anywhere from $50,000 to $150,000, equipment to $250,000. A lot of times we just need an application, we submit it through, and they base the majority of the qualification factors on your personal and your business credit. And of course the revenue is definitely a factor in order to streamline the process. But the average rates that we've found is anywhere from 5 to 9%, from 3 to 5 year terms. And it can take us anywhere from 1 to 3 weeks from submission to close once we are ready and they pass compliance. So some of the factors that we look for in personal credit is anywhere from 660 to 680 FICO. However, that's the minimum that's needed. But if we're able to get somebody from a 700 or a 740, the process will go through a lot quicker and a lot easier. At the same point, the interest rates that is offered will be a lot lower. So it's in your best benefit to get your scores as high as possible before we go and submit. Now, some of the things that the minimum requirements that we look for is, 4 trade lines, typically around $5,000 each at minimum for like revolving, autos and installments. But for an installment side, we like to see around $15,000 to $20,000. Revolving was around $5,000. But in total, it's great to have at least $40,000 in total accounts in total trades. Why? Because if you're going to request a $50,000 to $150,000 loan request, the banks want to see that you've had that experience of paying back a large amount of debt in a timely manner. So the years that they want to see, the minimum years that they want to see here is anywhere from about 2 years in history. Okay, credit utilization from 30 to 50%. Of course, we like to see lower the better, but if it's at 30% is usually the benchmark at maximum, but it depends on the request and the other compensating factors. If they have really strong revenue or strong business credit, sometimes that can compensate and push to approval before we submit or after we submit. We don't like to see any derogatories, delays, collections, public records, etc. That does scare a bank for your payment history, which is one of the main factors for your credit score being low. Of course, there are exceptions to the rule. So if you've had a blemish, you're on vacation, or something happened, your bookkeeper forgot to make a payment, there is those exceptions, and of course the banker that you utilize, and of course each bank has different thresholds for personal credit. Some are very, very strict, some are more common sense. Depends on the lending institution that you're working with. Okay, and low credit for inquiries. So we typically like to see anywhere from no more than 2 or 3 recent inquiries. If you have excessive amounts, 6 or 7, 8, 10, it can actually scare a bank from wanting to lend you because now you're overextending yourself or you're shopping too much, and it could actually drop your scores and be a red flag for banks. Next thing is your business credit. Just like personal credit, it is very essential that you build your business credit. So if you have a minimum of around $25,000 in different trade lines being seasoned on your account, it's going to help with the approval process. Of course, just like personal credit, no major delinquencies. If there is any, of course, we would have to have a good explanation for what happened, be able to explain to the underwriters so they don't deny you. No existing UCCs. Now, of course, there's exceptions to the rule. If you have equipment that's collateralized or a different loan that is collateralized by real estate or inventory or some sort, that does produce a lower risk factor for banks. But if the rule of thumb is that they don't like to be in second position, because if in the event that you default, you go bankrupt, they don't want to be in second or third or fourth in line in order to get their repayment of the debt that they lent you. Now, UCCs 1s are what I call the deadliest of all UCCs. That means that the lender is blanketing all assets, and in order for us to proceed or get you qualified for the next tier, you would have to either consolidate or pay that off before moving forward. Now, for this program, banks like to see a minimum of 2 years in history. They want to see that track record, that you've had that growth and you've been able to sustain the loan amounts that you're going to request. For equipments, there is a lot of banks and lenders out there that will do startups, typically a higher interest rate. It's not going to be the same as if you were 2 years in business, but there are a lot of lenders out there that will accept startups. Now, financials, it's loan amounts based upon 10 to 15% of your gross revenue. So if you're requesting $150,000 and last year you made $200,000, well, your calculation of 10% is a loan amount of $20,000. The bank's not going to want to over leverage you because you don't have that establishment of growing your revenue at a higher element. So that's very important to understand if you go through and you qualify for this type of program, that your revenue should sustain the request for the loan amount. All right, the next section here is personal and business credit cards. All right, great tool. If you're a startup or your revenues aren't all the way there, you have banks look at this more or less on your personal credit, very FICO score driven. So the request anywhere from $25,000 to $150,000. And the great thing I love about business and personal credit cards is that the banks will give you the 0%, 18, 21 months in terms. So that's essentially free money that they're providing you. And if you're able to get a few approvals, they can fund your business or your growth plan, accordingly at a very cheap rate. So a lot of our clients, they utilize this is actually they prefer the 0%, or they get a compilation of different cards to be able to help them with their target. Another great thing is that there's no collateral needed, based purely on your credit. Startups are okay. You give you 1 day in incorporated and start going through the qualification factors to get your 25 to 150,000. It's application only, it's streamlined, can take anywhere from 1 to 2 weeks in turnaround time to be able to achieve those cards in your inbox. Now, as I stated, personal credit is a major factor here. This is more or less the criteria that we like to see. However, I don't like to see more than 30% credit utilization before you submit, because it's really based upon your credits, your personal credit. And of course, banks want to lend to people who don't need money. So you want to make sure your snapshot before you submit is very great and is optimized. So it's also a great tool to roll back into other lending programs, and what I call the stepping stone. So if you're trying to get qualified for a working capital or an equipment loan, and you need to just say pay down some personal debt or pay for a particular tool or resource needed in order for you to get qualified for these other programs, it's a great tool to be able to leverage and utilize that and piggyback so the other two programs can fit into compliance. All right, so the next section here is accounts receivables, invoice factoring, contract financing. These are all great tools if you are established, or you work with what we call your accounts payables, the person who is paying you. I'll give you an example. If you're working with Walmart, they're very notorious for paying you 90 days after they have sold the product that you have you provided them. So if you sell widgets, you send it to Walmart, they will pay you 90 days from that. Now that really kills your cash flow, because you need that particular revenue, reinvest back into the business, grow more products, etc., etc. So there's factoring companies that will say, hey, I'll give you 95, 97% of the invoice that Walmart is going to submit to you. We'll collect the money from Walmart, we'll pay you up front, you pay a small, what they call a discount fee, and it allows you to progress and grow your company accordingly. They can grow with the line of credit The more receivables, invoices that you have, they can actually increase it. It's a great tool, especially if you're you're well established and you collect that money from your payables. So you can take, usually factoring is very common from 30 to 120 days of receiving that invoice. And so one of the qualifying factors for accounts receivable financing is that the person you're dealing with has to be reputable. Can't be some shell company or some startup that's doing business, because the bank is relying on the person that you're doing business with if they're going to make sure that they pay the lender. Of course, lenders are not in the business of losing money. So if you definitely have to make sure that they're established, they have good business credit. Especially business credit is an essential, something that they look at in order to get you qualified for that. All right, so the next product that we want to look at here is SBA. Great tool. The government backs up the bank that is lending the loan request for you. You can go up to $5 million. Terms from 10 to 20 years. Now the essential from here is what? It's 3 to 5 year terms. And if you can cut your payment in half by getting qualified for an SBA, it's in your benefit, right? If you're, especially for startups, it's a great tool. And I'm gonna go a little bit deeper into here momentarily. But everything from working capital, equipment, business acquisitions, commercial real estate, they have all different products and programs needed for you to grow your business. So great for startups, as I was stating, also for existing businesses. But if you're a startup, typically you want your last 3 years personal tax returns. Okay, they also would like to have you have skin in the game. So if 10 to 20% is a typical down payment, or if you're collateralizing it, you have existing a house with equity in it, they're going to put a lien on that equity for the excess to be able to help sustain the startup there. Credit is definitely a factor, very similar to this criteria. I think it's more FICO score driven, but of course every SBA lender has different criteria. Some are a little more relaxed in personal credit, but you should get into the habit of making sure that your scores are in the 660 to 680 range. There's a lot of tools and resources that help you expedite and increase your scores. Look at other videos that we've created, for that education. For startups, one of the necessary elements they need is business plan or projections. They want to know that the plan that you're going into, that it's sustainable, that you've actually thought out the whole roadmap in order for you to get qualified there. So you want to be able to have that ready if we submit with SBA, and they want to know that you had experience in that industry. So if you've been in construction for the last 10 years, all of a sudden you want to move and buy a franchise for restaurants. They're two different industries, and so it's more likely that you won't succeed very strong in the restaurant business if your whole career is in construction, unless there's a common denominator between the two industries that you can merge and present accordingly there. Last thing here is for business, especially for business, is business cash advancement or merchant cash advancement. MCA is very commonly known. This is where the bank is giving you, is really looking at your last 3 to 6 months of your bank statements. Cash flow is king in this arena. Great tool for somebody who's looking for either a bridge loan or short-term financing. I don't recommend it if it's your final product that you're trying to qualify for. Okay, we use it as a tool to roll back into other programs. If your personal credit is shot or high utilization, there is a lot of different ways of playing with the program to help with that end result. 6 months of business, up to 500 FICO scores. So this is where we're looking at the business. If your personal credit is, it is a major factor, and it can reduce your interest rates. And I'm going to get into the way the factor lines work, with this and how that is all integrated and work together. But at 500 FICO, if they're basing it, the revenue off the cash flow, they'll increase the interest rates, but they will lend to you that can solve your immediate needs there. Very quick turnaround time. I've seen it as fast as 3 hours that somebody has gotten approved, but 24 to 72 hours is the norm. The way they work with their repayment, that they will take daily or weekly withdrawals from your bank account automatically. So be aware of that, because if cash flow is an issue, you definitely want to qualify for the monthly programs versus the daily, because it can hurt if you're not careful. I always say these are the recipe for going bankrupt if you don't utilize if you don't utilize this correctly. It can be very dangerous, so be aware. Now, the factor rates for how do merchant cash advancement companies work, these alternative lenders. So they have something called a factor rate, which if you're at a 1.1, the range is from 1.1 to 1.5. What does that mean? So if you had a 1.1 factor rate, if you have a $100,000 loan request, that means that when you repay that lender, that you're going to pay him back 110%. So $110,000 is their factor rate. So if you're at a 1.5, for every $100,000 you're borrowing, you're paying back 150, and of course the terms could be very average terms, from 3 to 12 months is the average. So you're paying back 150,000 within 3 months. You can see that that daily payment is going to be very high. So use it wisely. That it does have a purpose, but not at the end result. It's very, very big in. If you go to Google and you type in business loans, what I've seen is that a lot of the major merchant cash lenders have paid very big money for Google to be on top in order to get you into that program. All right, the last thing here is personal loans. Now, personal lending is, just as it sounds, is based upon your personal income and your personal credit. So $25,000 to $500,000, average of 5 to 10%. It is unsecured. So it means that if you don't repay it back, there's nothing for them to collect as far as collateral. There is different types of lending programs for secured financing. It's easier for you to get financing if you do have collateral, but the majority of them are unsecured. 3 to 5 year terms. I've seen it even high as 7 years through different qualifying factors for banks. 1 to 2 week turnaround time. We've gotten approved as fast as 24 to 72 hours as well. But you want to build in about a 1 to 2 week turnaround time from that. Personal credit is a huge factor. I like to say at least 30% utilization. Very similar to the criteria that I see here. The stronger the credits, the more money you're able to obtain. Okay, so just for an example, if the average of, like, if you're applying for a credit card, typically the approval rates are depending on the strength. The credit limits dictates the limit of the approvals that you receive plus your income. So if I have an average of $20,000 in limits on my credit card, typically when you go for an approval, you'll get a $20,000 to $25,000 approval, versus somebody with $5,000, it's going to be much lower. Very similar to personal loans, a little bit different factors. A lot of them is term loans. There is some line of credits available, but the financials is what they look for. So personal credit and financials are the two main factors that they look for. So if you're an employee, typically you need your last year's W-2s or your last year's tax returns, your 1040s. And the last 2 recent pay stubs. They want to see your year to date, your growth factor, how are you doing right now? Is it overachieving your last year's revenue? Are you growing? Are you staying the same? These are all determining factors that they look for. For self-employed, it's typically your last 2 years tax returns, your personal. And what I found with working, of course, with small business owners, especially if you're a contractor, 1099, etc., that you have that ability to expense a lot of your income. So when it comes down to if you made $100,000 but you expense 95%, you're netting $5,000. That is a determining factor that can hurt you in that range. So always project 2 years ahead of the road. If you're going to want to apply for loans, or if you're making some good money, you want to retain it. How do you expense your income to pay Uncle Sam? So we've gone away with 1 year a lot of times, but typically we ask for 2. in order to get you qualified and analyze and pre-underwrite before submissions. All right, so there's a lot of information here, and how you're able to utilize each program and the types of loans and the qualifying factors can really help with the achievement of getting you to your target for your loan.